Monday, the 27th of February. Goodness me, we are now nearly 2 months into 2022. And boy, oh boy, what a start to the year we have had. I don't need to remind you, of course, what's gone on in the last few days. And in fact, last week, we really had no idea if Russia would invade or not, or what to expect if they did. We saw the immediate reaction to the incursion, probably as one would imagine, with an immediate flight to safety. Our first presenter this week, of course, warned us of volatility in the first week of a possible invasion, equating to a volatile market. I mark him 100% on that. Certainly I witnessed that in the last few days. I'm sure you did as well. Yeah, and particularly if I look at the flight to safety charts, you know, they've just gone. In fact, they've gone back to even where they were with interest in some cases. In fact, in most cases. So very, very interesting market. I guess Julian, who's going to join us now, and thank him very much for taking time out of his Sunday to, I guess, I nearly said at the beginning that this was a special edition of the Sunday market update. I don't probably want to go there, but I think it is something that we need to address, and no better person to do that than Julian. Mate, we now have a significant conflict, of course, which raises lots of questions around financial markets, like can we trade, should we trade, both from a financial and I guess from a humanity perspective as well, and how should we approach this coming week and potentially months?
Okay, well, maybe I'll handle the ethical questions first, and say to anybody, if you're having ethical problems with trading financial markets in any potential conflict situation, then I suggest you switch the screen off and go away and just do something else for a couple of weeks while things resolve themselves. For those of us who aren't who aren't quite as ethically compromised, and I probably put myself into that category, having been through a few of these situations in the past. I'm not trying to sound flippant about it, but I think it's an important distinction to make, right? I totally get it. People who feel nervous and feel, stressed about this. You do not want to be trading when you're under stress. If you're in my case, where we're quite a long way from anything, from the action, I think, so to speak, Geoff would be a fairly good description. And it seems very distant to us, then I think there's opportunities, right? And so we can look at this and we can say, right, how do we manage this, and how do we manage ourselves? Because without, am I allowed to say war markets? Let's not say war markets. Let's talk about conflict markets, maybe a better idea, because nobody's allowed to use the W word anymore. So this is essentially the first time. It's very destabilizing that Europe's had any type of conflict. We all get what's happened, right? We all saw the lead up to the conflict breaking out. We all saw the conflict starting. Let's call it peacekeeping, but we all saw it starting for whatever reasons. And I don't want to get into the whys and wherefores or the conspiracy theory of any of this. None of that really matters to me, right? What I'm really interested in is what the market's reaction is, and secondly, how we can make money out of the market's reaction. Inevitably, in these situations, two things start to occur. Is markets hate uncertainty. So to some extent, the uncertainty of isn't it going to happen? Then the uncertainty of, oh my God, it started to happen. That's quite interesting. What's going to happen? What's going on? And then the obvious, I can only really describe it as fairly muted speech by Biden. But again, this is the interpretation that's incredibly important. Not very many of us are Americans. But some days people just, if you're an American, just need to hear the president talk to maybe give you a little bit more comfort that maybe the sky isn't falling. And anybody who does any type of research will be fully aware that, the importance of Ukraine, to the world grain markets, to the energy markets, especially European energy. We all get that. We all get the geopolitics. And by the way, guys, that's in the market. It's out there. You don't think the market hasn't thought about that for the last 3 months? I strongly suspect if you speak to any of the oil traders, the only thing on their mind the last 3 months is what's going to happen over the Ukraine question. Right? As soon as it was flagged by the US as being a problem, or by the Western allies as being a problem, then immediately people started to get concerned about it, and the uncertainty is palpable over Ukraine. It has such a pivotal role to play in both the European energy markets and to some extent the wider Asian energy markets as well too, that you can't mistake that, you can't get that wrong. And so consequently the market has been trading poorly in terms of asset markets. Yeah, we can talk about the Fed raising rates, we can talk about the Fed tightening. Quite frankly, the Fed is tightening interest rates and beginning to raise interest rates from zero, right? They still haven't done it yet. They're going to start talking about it when inflation is at 7%, so real interest rates are at -7. I think we need to get a bit real here, right? And secondly, they haven't actually stopped their balance sheet expansion. That actually stops next month, right? So the Fed is still unbelievably on quite a easing path. And if you were looking at it from a helicopter view with any sense of history, you go, they're on a massively expansionist path at the moment, and there is no way that this is called anything other than anything like a hawkish interest rate environment. It's banal to even have those conversations. So, however, the world does what the world does, right? And our job is to make money out of all of this. So what are we thinking here, right? Number one, right? What happens in times of high volatility, guys? Now, rather than putting answers on the postcard or you coming through on the chat with some answers for me, it would always be useful if you guys want to converse with me, if you've got an opportunity here, this is the time to do it. But number one thing starts to happen, right, around conflict times, right? Volatility will increase. We've talked about this, and to some extent we knew it was coming, and this is quite important. Okay, because we knew it was coming, okay, then when it arrived, we got the volatility that we were looking for, right? Nobody quite knows, and you don't have to read many books on battle strategy to understand that the plans all go out the window on day one, right? So uncertainty abounds, right? With uncertainty comes volatility. With volatility, traditionally, asset markets will suffer. And for those of you that are trading the oil market, you'll have a very good idea of what I mean about that, right? The uncertainty in the oil markets has been driven by higher prices, not lower prices. In fact, one of the things that's been holding the S&P up, in fact, the last 2 or 3 months, has been the overall outperformance of the energy stocks, right? So, so when you think about this, right, the key to the key thought that has to enter your mind is, right, things are going to be choppy, they're going to be crazy, things are going to be difficult to read, things are going to be difficult to interpret, because I'm not the guy who gets the news first, right? And I'm not talking about the big guys out there versus the small guys. I'm talking about the White House and the Kremlin get the news first, and then everybody else gets a version of it, right? Now, whatever that news happens to be. So what we have to do is we have to try and roll with it. There are going to be times when things are going to seem completely ridiculous, and there are times when things are going to seem utterly logical, but most of the time we're going to be dealing with chaos. So how do we then trade through chaos, right? Well, we do exactly what we've always done, right? Everybody out there who trades and has been trading for some time will have a methodology of doing it. You will have a way of managing your risk. This is the point. If you've been around trading for quite as long as I have, then you understand how to manage risk in these environments. Is this one of those moments in time when you can start to bet the house on a particular trade? Well, I'll leave you to decide whether that makes sense or not right now. But for me, it doesn't, right? My personality won't allow me to do that. What my personality allows me to do is to be really fast and flexible. And I think that's the key thing about how to trade through these. So I'll give you a couple of different examples. I remember very clearly, and this just goes to show how long I've been doing this for. I remember very clearly the Kuwait invasion, the first one, not the second one, right? And what that did to the oil markets and what the impact on the oil markets was, and actually just asset markets in general there. And what happened is, as soon as hostilities broke out, as soon as the US decided to go in and do something about it, when that happened on that day when they went in to liberate Kuwait, there was a tremendous rally in the market. They'd been selling off for days and days, and then there was a tremendous rally. Why was there a tremendous rally? It's because the US and the allies were using overwhelming force against a far inferior foe, but nobody knew it at the time, right? There was lots of talk, right? So this is why I'm saying this. We can all get the big picture stuff, but what actually happened is they almost won right from the get-go, right? And so this is why you need to be flexible to be able to turn your thinking around. It's no good just to say, it's been going down, therefore I'll try and sell the next bounce. What normally tends to happen in these markets is you take a step back and you say, right, where is the world at the moment? So let's think about where the stock market is at the moment. We've been in a declining market. If you're trading a lot of NASDAQ off the run stocks, you know what a declining market has been the last 9 months, right? If you're trading Facebook, you know what a declining market has been the last 3 months. Okay, so it's a declining market. What we saw after Biden's speech on what was, I think I'm trying to remember, Thursday morning our time, I believe it was. So Wednesday evening their time, vaguely. You guys know when it was. For those of you that were walking past it, you knew that this was a significant event, right? When Biden stands up on the podium and starts to talk about this, you've got to listen. Why do you have to listen? Well, because things might change, they might turn around. And you already saw in the market that day, you already had the beginnings of it to see a beginnings of a bounce, right? Now, why did we see that? Well, because people had a whisper that obviously something he was going to say X, Y, or Z. All the journos get a bit of a advance warning of it. And, interpret it however you want. But the key thing is, it was a newsworthy point that you have to be able to flip your opinions on. So what I mean by that is, you've got to be able to say, right, I'm not going to work on it's going down, I'm going to sell every retracement. This could be a complete turn in the market. I've got to be prepared for that. Often, many of you won't have experience of trading conflicts before. Sadly, I've got experience of trading 2 or 3 of them. And when these things happen, what tends to take place is the sell the rumor, buy the fact type of situation. Okay, so you walk into it with a lot of uncertainty, a lot of nervousness, a lot of anxiety, and then 2 or 3 days in, all of a sudden everything changes on a dime, and it often can be a market turning point. It can maybe work the other way as well too, but let's park the caveats, right, and just go with at the moment. So you have to be able to turn your thinking around and not say, I don't understand what's going on. The market's going up now when it was going down, or this must be something that's not going to last back. No, something has changed. So what's changed? So the reason why I asked Paul and Geoff if I could do this slot today and elbow Ash aside for the evening is I wanted to talk about this in slightly more detail. Right now we can go and have a look at a couple of charts, which we'll do in a minute. But the key thing about this is the key turning point for the market, the reinforcement, what changed everything was Biden standing up and saying they're going to put sanctions on Russia. Now, for those of you who could interpret the subtext of that at the time, right, which I don't think many people had the ability to do that, right? But if you had the ability to do that, or you knew about it in advance, you would know that within that, Biden did not say we are going to put sanctions on the energy markets that Russia and Ukraine are so significantly intertwined with. Okay, so what he did is he turned around and said, everything else that those good 2 guys do, that Russia does, is really bad, but we're not going to stop the oil flowing. Right, and that's what the oil market needed to hear, and that's what the stock market needed to hear. So think about it another way. It's heartless. I don't quite know, and there's a lot. This is ridiculous to say. It's not a great time for those people in Ukraine. We have to park that emotional side of things and go, right, what's changed? What's changed here is a piece of news that came out that, again, the market was expecting to some extent, but didn't expect the lack of severity of it. No US involvement, no energy sanctions. Immediately the market started to rally. Why? Because they saw the conflict as not widening. Okay, the US essentially said, oh, okay. And now you could argue whether that's a good or bad thing, and we can all get our long-term strategic hats on and all the other stuff about geopolitics, but we don't care about that. What we care about is making money today, and what we care about is how we trade through this. So the previous view that the market had, I'm going down on uncertainty, I'm going down on uncertainty, I'm going down on uncertainty, was completely reversed in a nanosecond by the attitude of the US president to say, yeah, I know, but there's not really a lot I can do about this, but we got to keep the oil flowing, because that means that we keep inflation down if we keep the price of oil down, and that means I'll probably get re-elected next November if I can keep the price of oil down. So as a result of that, right, I'm not going to do a huge amount here. It's really sad for everybody who's involved, but actually, we'll find a way to help, and we'll find a way to impose sanctions on them in the long term. That was sort of the subtext of what I believe the market saw. So what they saw right now is a de-escalation of the crisis, although you could, It doesn't look that way on the TV screens. They saw a de-escalation of crisis and consequently the market turned around. This is identical to the situation in 1991 with the invasion of Kuwait, right? Once the market saw the overwhelming force and the ludicrous amount of strength that the US had brought to bear on a relatively inferior ally, they realized that victory was just a matter of time. Consequently, the markets turned around incredibly quickly and began a bull market that was sustainable for some time. So here's the question that we have with this, right? Number one, have we identified a key turning point? It doesn't take an expert to look at the oil chart. Maybe we should go look at this, guys, just to reinforce this point, right? I'll share my screen. Let's go and have a look at this, and we'll go have a look at oil. Okay, for those of you that are involved in any technical analysis or know your way around technical analysis, you will know that that is somewhat of a excess point. Okay, so the move up to over 100 in WTI and on the run WTI, we're now back at 92, right? That's an 8% move in a day. That's extraordinary volatility. Why has that happened? Well, because we know why it's happened. It's a volatile market. Why did we get up there in the first place? Because the invasion was on. Why are we back down here now? Because Biden spoke. He put everybody's mind at rest that this is going to be a contained conflict for the time being, right? Okay, for the time being, but that's what we wanted. So think about it from a sentiment perspective, right? He made people feel a little bit better. Market completely reverses. Now, what's the second reason it reversed? I guarantee you there isn't a single person who has been trading oil for the last 3 months in any way, shape or form who'll be running into this market with a core short position. Okay, that would be completely weird. The vast majority of people who have positions in the oil market right now would be long. So that makes sense, doesn't it? Okay, why would you be short? There's no reason to be short. This market is just trading up. We go and look at a slightly longer term time perspective. Since we had those spikes, where were they? Guys, they were in the 60s. Oil has rallied almost 50%. There is nobody out there who is short of oil. Everybody went into Thursday's speech with Biden with a long position. So what do you think was going to happen? Okay, this is the key thing, right? This is how you take the technical analysis tools that we have, you interpret them at the time, and you have to move quickly. Not being aware of the speech was a bit of a mistake if you weren't aware of the speech. Secondly, not acting on what was taking place. The world has changed again. Okay, that's what the market's telling you. If the market is wrong, right, then the market will be wrong when we take out $100 on WTI or 103 or where we got up to on Brent. Right? If we take out that excess point, I guarantee you that something else is going on, something else that is unforeseen and we didn't catch. Right now, oil sits on a super backwardation. For those of you who don't know what that means, then please go and look it up on one of the previous talks I've given over the past few weeks and months. But this curve is super backwardated in oil, which means that at the moment, everybody is looking for oil. Okay, right now, I think they're all going to get it. Right now, I think there's been a lot of people short-term, traders short-term have been hanging on to their oil positions because they believe they can sell it tomorrow at a higher price. Now that is being brought into question. Okay, so a quick look at what happened to some other markets as well too. Here's the gold market. I think this goes down as one of the biggest moves in gold on any particular day that there's been, that I can recall anyway. It was $100. Okay, now percentage-wise, it's not a huge amount because gold doesn't move an awful lot, right? Literally, gold doesn't go anywhere. Its volatility is one of the lowest asset volatilities in the entire market. Again, from a technical perspective, what's happening here? Okay, what was is now not what's going to be. For the time being, gold has topped out. Where does it go to from here? I don't know. If I had a crystal ball, we wouldn't be having this conversation, right? What I can do from here is we can estimate that somewhere in there is either going to be two things. If it's bullish, it'll go sideways. If it's bearish, it's probably going to go down. If everything changes with the world and the world goes downhill or the conflict escalates, I would imagine that we will go back to new highs and we will get up to the 2100 level that we got up to 2 or 3 years ago. But right here, right now, what we've got to do is establish time. Okay, time to build the position up and for people to get confident with whatever position they want to hold. Because right now, if you're long of gold and you've been, again, 3 weeks of gold going up, do you think many people were short of gold coming into the conflict? My answer to that probably would be no. I think a lot of people would have been long as a safe haven asset. Here we go again. What happened? Okay, well then they got a bit screwed on Thursday and Friday, right? So think about this, right? This is how you got to think about this stuff, right? All the time. What are people's positions coming into this big news item, massively big news item? Okay, how are they thinking? What happens when something switches? Do we need to switch our thinking immediately at 180 and start to think about the opposite direction? Should we now be thinking about shorting gold and shorting oil? Well, again, what the market's telling you is probably for the time being flat to short is probably the right trade. I would stress at this point that, again, it's a risk environment. We have to be careful. We've got to use our tools. We've got to trade our methodology. Do not go outside the box at the moment. Okay, this is not a time to go outside the box and try and think about, well, maybe I'll just do this. I know it's not what I normally do, but I'll just go and try that. This is not the time to be trying new stuff, right? Stick with your knitting. Okay, any methodology that you use, make sure you carry on using it and you take the signals when you get them. But there's an overall theme going on. Try and trade with the theme if you can. Guys, I'm sort of, at this point, I know I've just been talking. I hope you've got the gist of what I've been trying to say. That this is really the bottom line to all of this is when the trend reverses, you've got to reverse your thinking, and that reversal of thinking in a conflict environment has to happen almost immediately, within minutes. Okay, you've got to turn around and say, from my perspective, what I did, I managed to get out of my gold positions, my platinum positions, and I didn't have any oil this time around. I then also, at the same time as Biden was talking, I began to buy stocks. So I've been buying individual stocks on Thursday and also on Friday too. Who knows where this is going to go to as a rally? I don't know any more than anybody else. But what I do know is something happened on Friday, which is not, to me, is bullish short term for the stock market. It may last another day. It may last another week. It could last for 6 months. I don't know. Who knows? Right, but right now my opinion switched almost immediately to thinking about the long side in stocks and not thinking about the short side for any considerable period of time, unless again something changes. Okay, so I hope that's useful for everybody about the way that you need to think these things through. If anybody has any questions, post them here. If not, then I hope you enjoyed the session, and I apologize for making it a bit of a special one, but I wanted just to convey this thinking about what to do in these situations.
Mate, to apologise for delivering something that it really should have enlightened everybody who's listening to this. And I don't mean that in a whimsical fashion. Absolutely fantastic and a great aspect of what's going on at the moment. There are a couple of questions coming in, and whilst that's happening, I'll kind of ask one of my own. And the summary I get from that really is, if you're not paying attention, you probably shouldn't be in the market at the moment.
Yeah, look, I think that's probably fair. I've never watched the news so much. I'm not a great news watcher anyway. I don't necessarily trade through numbers or anything like that anymore, but when something like this is on, it's not out of morbid fascination. My wife always gets frustrated with me. It's not out of morbid fascination I'm watching the news. What I'm watching for is a change. Because during that change, I can add 5 or 10% of my account to my account very quickly, very easily, by just making sure that I'm able to turn my opinion around really, really quickly.
Yeah, totally. This is, I hate to say it, but from look, can I go back to that ethical point of view? Because people do struggle with that. My thought process on Thursday was talking to the people in Trading Buddies was that, look, if you're going to make money out of this, which is entirely possible if you are on the right side of things, obviously, and you've just given us a very, very good indication as to how to do that, why wouldn't you, if you are in an ethical dilemma, why wouldn't you donate some of those profits to the relief of the Ukraine when it's appropriate? And there'll be plenty of people looking for fundraising to relieve what's happened in Ukraine. So put a little positive spin on it that way, I think.
Yeah, look,
can you read the questions, mate?
Exactly, and I think a lot of people handle these things in different ways. I have to be very careful here. I have a relative, I am an emotional guy, and I'm a terribly empathetic guy as well too, but not when it comes to trading.
It's your job, right? It's your job
yeah,
to make
exactly.
money.
Exactly. And so, look, there's some. I know there's some questions that have come up here. But so look, one thing I would make, Fab. Okay, the key thing about what you've asked is you saw an article that was talking about the move in US equities. Who cares? An article is something that is written after the event. That's it. So why worry about, I'm sure there's been 100 articles. I haven't actually read a single thing since Thursday, because I saw all I needed to see with one speech. That's it. And that's real time. So think about it another way. Leading indicator, lagging indicator, right? The article is a lagging indicator. I don't need to know about what somebody was seeing yesterday, because that's too late now. Right? The stock market was up 5% by the end of the day before that guy or girl wrote that article. So I'm going, well, actually, I prefer to trade before then and try and make 3 or 4 of that. Just looking at some of the others that are here, and I appreciate the comments. Thank you, guys. So the current retracement in the euro is temporary. It's a major trend. Well, this is a slightly more nuanced question, right? So there's 2 things going on here. A major trend reversal because the euro is really cheap. Okay, so who knows whether the euro is cheap or not? I think if you asked an Italian, they would say it's expensive. If you asked a German, they would say it's cheap. Right, so I think that it's very difficult to try and make that sort of judgment. So is the euro going to go up, or is the euro going to go down? At the moment, it seems to me that the only thing that's holding the euro in place right now is Lagarde's press conferences. When she changes, then the euro will change direction. And at the moment, Lagarde is, again, it's like, I find it incredible, right? They talked about Lagarde being hawkish the other day because interest rates went from -10 to 0. but inflation, so -10 basis points to 0, but inflation is running at 5. It's a negative real interest rate of 5%, which from a historical perspective is extraordinary. It's 3-4 standard deviations away from where you would consider that to be hawkish. I'm looking, some days you have to look past the newspaper articles to call Lagarde hawkish the other day. Interest rates are still 0 in Europe. Get a grip. So it's like, hang on. Okay, so when the policy towards interest rate changes, then the euro will change, right? That's the thing here. Otherwise, what happens from this point, okay, is you risk, if this conflict escalates or widens, you risk a loss of confidence in Europe from a political perspective. I suspect there's already some of that going on, right? And so super long term, there could be an undermining of the euro because there's an undermining in the confidence of the European allies to be able to organize themselves into any kind of future defense for the rest of Russia's near abroad regions, right? Because if you don't think he's going to stop here, then then there's more coming, right? And then where do you go next? And all of that stuff, right? What will Europe do on the next one? This is a record and a history lesson that we've seen before. So many, many times for the record over the last 2,000 years. So, this is where having a healthy dose of history helps, having an understanding of Russian culture helps, and that will help you understand what's going to go on with the euro if this conflict is going to be extended. If the conflict ends quickly, it's all down to what Lagarde's going to do on monetary policy. I hope that helps answer that question. I'm not quite sure it does, but that's my thinking at the moment.
And possibly in relation to the dollar, it probably will struggle in this time if the market continues to be a little bit tetchy, one would have thought.
Yeah. Look, again, it's the same thing, right? People will run to the dollar because it's the safe play at the moment. Nobody's knocking on the dollar's back door. But then we say that. But then for those of you that are following what's going on in the Arctic at the moment, you will know that that's absolutely not true. And the Russians are being very, very frustrating to both the Americans and the Canadians in the Arctic region as well, too, in terms of what they're doing about a land grab up there, too. This is not a limited, isolated situation. It's happening across the whole of Russia's near abroad, which includes the Arctic, because they believe they have rights up there too. So there's a lot of things that if you haven't read about, you need to learn, you need to read up about this geopolitical stuff. But is it going to move the markets on any particular day? I doubt that. right? So just remember, if you lose confidence in the dollar, that's going to create a lot of additional problems for both America and, quite frankly, for the rest of the world. Equally, that also works for the euro as well too. Right now, losing confidence in the European political elite will probably be quite a poor move, I would imagine, for the euro.
JP Morgan probably would like to eat their words, in my humble opinion, when they came out a couple of weeks ago and said, this is pre-conflict, of course, that the Fed were looking at 9 interest rate rises in a row. That doesn't seem likely under the current circumstances.
I have the one thing I've learned about Fed policy is never to getting the direction right isn't that hard. Okay, mainly because the Fed's told you, right? So guys, we all know, and girls, we all know that interest rates are going up in America in the very front end, right? Forget the long end stuff. In the very front end where the Fed can influence, it looks like interest rates are going up. The one thing I've learned never to do, because I've made that mistake a number of times in my trading career, is to try and predict where they're going to stop. So it could be 9, it could be 15, it could be 3. I have an opinion about that. My opinion is it's going to be nowhere near 9, but that's my opinion. It's absolutely worthless. I'm not sure that Chairman Powell has phoned me recently to ask me what I think about the economy. So consequently, I prefer to listen to him rather than listening to me.
Well, interestingly, 9 interest rate rises in a row is 72 weeks away from now.
Yes. And there it is, 18 months. It seems to me that a week is a long time at the moment. They say sometimes a week is a long time in politics. Well, believe me, when people are firing at each other, it's a hell of a long time. So, yeah, totally. Let's see. When dust settles, let's see what's going to happen next.
Yeah, agreed. There's a lot going to happen in that time. There's no question. Speaking of questions, have we run out of questions, guys? If so, I'll release Julian to the rest of Sunday, which has got about 1 hour and 28 minutes left for him.
I think that's I can't see anything there. And thanks everybody for listening in. Appreciate it.
Mate, you froze up there, so I'm not sure exactly what you said, but I think the sentiment was thank you for listening. And from all of us to you, thank you so much for the contribution. It is enlightening and worth really having a replay of what you just said, guys. If you didn't take it all in, please do that. Replay it and take heed. Julian, thank you, mate. Catch you later.
Cheers.
Right, guys, our next presenter coming to us as a recording, and I've got to tell you that, I've just lost my control panel. That makes it very, very interesting, trying to bring you the next video. Let me see if I can restore that. There we go. The next presenter has absolutely a disregard for whatever's going on in the world, which is an enormous contrast to what we've just been talking about. I'm going to bring him up now because he trades 5-minute charts and he trades all of the things that you would expect him to trade on a weekly basis, and that is gold included. So I'll be interested to hear what the technical aspects of his view is going to be in the next 7 or 8 minutes or so. So let's bring him in, and he's going to introduce himself. So let's start with that.
Now, I'm just going to share my screen and just talk to you about something that I think is very interesting. So just to avoid a little bit of distraction, I am going to switch off my video. Now, what I want to talk to you about is the patterns that happen at the open whenever a session opens. I really think it's important because we find great opportunities to make profits when the markets open. The reason I find it fascinating is that when you trade in indices, for example, the different stock exchanges have different opening times, but because they're all part of the global markets, the major session openings also have an impact on them. So let's have a look at Hang Seng 50, Hong Kong 50, top 50 companies trading off the Hong Kong Stock Exchange. Let's have a look at Friday, and I'll give you a little bit more detail about the exciting things that I think we must all have or bear in mind. So this was Friday's candle. Look at the previous day. So guys who come to my show, you know some of the basics always put in: low of the previous day, red line, high of the previous day. So this is a level of support, level of resistance that we need to keep a watch on. Then, of course, you plot in your 50% pullback. Just use your Fibonacci retracement tool, bottom to the top, and there is a 50% level, market whatever color you want, just use a light blue line. Then the open of the day. So we trade off the 5-minute time frame. Let's go straight into it. And let me show you what I'm talking about. Okay, so this is a day that took place on Friday. Okay, now midpoint, like I showed you, there are patterns that tend to repeat themselves. Now, when I say tend to repeat themselves, we're talking 70, 80, 90% of the times. If you look out for these patterns and wait for them and trade them, you'll be able to get good opportunities. So I talk a lot about 3 push patterns, which are wedges. So here we had the gap up. Market closed here, market opened here, selling off on the first candle. But have a look at the pattern that formed in the early parts of the session. You got to wait for the pattern to form. So it might take an hour, it might take more than that, or it could be one of the other patterns, which is just a trend from the beginning, the bear trend, bull trend. But today we didn't get that. So here are the 3 pushes. Market went up here with the gap up, came down, went up again, came down, went up. Already have 3 pushes. You know there are forces in the market that are in favor of the bears. Any 3 push pattern is an indicator of bear forces. Okay, so one tick, I look for the 3 pushes and see whatever is formed for me. But also within that 3 push pattern, there's something that's pretty common. It's a double top. There is a lower high, double top. This high is lower than that. So we have the 3 push pattern indicating bear forces. We have a lower high, double top, also indicating bear forces. Market went up, created a high, tried to break above that, failed. So already I'm thinking bearish price action. Then I need to just continue to look for more confirmation. Okay. We have another pattern that is formed. This is formed with the double top. Okay, we call it the low one. So the market has gone up. First attempt to break previous lows. That's a low one. Very good. We have another low 2 here. Market went up and came down again. That's a low 2. Then we end up with the double top. Then we have a third attempt, a little break between that, which is a low 3, because market is going down for the 3rd time after going up. That's all confirmation of these 3 push patterns. So I'm happy, but I need a little bit more information. You could take that trade if you wanted, could have triggered double top after a wedge. You put your stop above here, or well, it's above there, but you could put it a little bit higher if you want, but that's the correct place to put it. So you can take that trade if you took it in the trade. If you're not in that trade, you have to wait and see where the next opportunity. If it goes immediately in the direction of the bears and it breaks out beneath that, you're going to wait for a pullback. Okay, and the pullback comes a little bit later on. But in any case, here the market went sideways, but the sideways gave us a lot of information, because the next time with the bear candle, we had an inside candle. So inside candle, fantastic, take a trade here. That's a pattern on the open. Now, the interesting thing about the Hang Seng is that the market closes at 6 a.m. my time, then it opens up again. So on the open of the second session, another pattern formed. Okay, you can see almost an inside candle here, outside candle, breakout mode, confirmation that the bears are carrying on. So if you're not in the trade there, and if you just come in the market, look for an entry here. If you don't take it, there's another lower high entry. Later on, this whole part is the opening of the the London Stock Exchange. Again, that market, the Hong Kong market closed my time, 10:30. Opens at 11:15, and you're looking for patterns at the open. Market closed with that candle, and we in a bearish price action from here. So we're going to look at the next candle and see what happens. Market opens yes, it's a high test candle, but why do we have a bull close? So alarm bells should be going off in your mind. Market bounces off here, which happened to be the low of last year. So with that indicator, you can't be holding your trades and going away and assuming it's fine, because that's a lot of information there. So then you got to manage your trade, okay? If you've taken a trade and we're here, your stop is at this level at this present moment in time, you see that, of course, you must wait for follow through to see if market breaks beneath that. In any case, might break and pull back, but it doesn't. When you get a reversal candle, which is also a bit of a trading range, if you're holding your trades, you close your trades. If not, you just trade your stop down. So that's all happening at the open of the London Stock Exchange. Now, the next open that's very important is, of course, this open of the US markets. And when the US markets open, the New York Stock Exchange opens my time, 4:30 p.m., 2:30 GMT, but allow an hour before for pre-trading. So again, you have to look at that price action. We're back within our earlier on trading range, this pattern that we traded. So there are forces defending that. So no surprise here. Again, 3 pushes, 1, 2, 3. So you got to find ways to get into the market if you're not yet short. There is another, almost a repeat of what we had earlier on here. If you don't take that trade, I mean, if you do take that trade, stop is still above that level. If you don't take it, wait for more bear candles. You can sell beneath that, put your stop against it at the same level. Then you got to manage your trade, get a 2-bar reversal, get out of the trade. So very quick, but patterns at the open are very important. And I will be spending a bit more time on that when we come to my show, when we get to my show. So see you on Wednesday. 9:30.
Okay, that was George, and hopefully you can now see my charts. My apologies, my finger problems where I forgot to press the sound, share the sound at the beginning of that, I've got to say. George is also going to join us in Trading Buddies tomorrow, if you can be there. And if you want to ask him some questions around his method of trading, that would be an ideal opportunity so to do. I also said when I was talking to Julian that the Fed had 9 in. I'm sorry, the Fed didn't have 9 in a row in their the meeting minutes. No, they didn't. But there was an article from JP Morgan that suggested that they were going to raise interest rates 9 times in a row. And I said that that was 72 weeks away. Of course, the Fed meet every 6 weeks, not every 8 weeks. So therefore, I'll retract that statement. And let's say 54 weeks, still a bloody long time, right? Let's put it that way. Okay, now pursuant to what we've discussed all throughout the show, in Julian's section of the show, which was all about if you're not in front of if you're not in front of the news, or if you're not listening to the news, if you're not paying attention, in my mind, that's what I take out of Julian's synopsis of how we should be looking to trade this situation, then it's probably best to stay out of the market. Now, I had my own opinions on where the market would go if Russia did invade, and I positioned myself for that to happen. Now, some of those trades that I placed in anticipation of that have now closed. I was wise enough to put my stops in a winning position when it did move. So that's not an issue. What is now an issue is reading, and if you listen to Julian, what he had to say, is now reading what happens next. And that is very much a case in point of listening to what is about to happen next and reading what statements are made, not by the newspapers, but by those who count, like Biden or Putin, for instance. They're the kind of guys that you want to be taking notice of. So if they've got speeches scheduled, then that's probably where we need to be focused. Now, the truth of the matter is, for me, I'm not in that position unless it's out of my normal business hours, if you like, because I run a business of my own. So I'm very, very hesitant to be in the market because I can't be in front of those news events. That said, I've got 1, 2, 3, 4, 5, 6, 7, 8, 9, what I consider to be game changer bars this week. The interesting part about that is I don't agree with a single one of them. From, I guess, and this is very, very difficult for me to say because I'm not a fundamental trader, but from a fundamental point of view, I find it very, very, very difficult to go with what the market, or sorry, what the candles are telling me at the moment. And I'll point to, look, just pick any one of those. And here I've got, well, actually, it's a monthly chart, so it's a bit weird. I do this on a weekly basis, right? Every Sunday, I look at what the candles of the week, the previous week, are telling me. And this candle's telling me that this market's going long. Now, I disagree with that because of the potential for this to escalate, the scenario to escalate. So if I'm going long CAD yen, it means I'm going against, if you like, conventional wisdom, which would dictate that a flight to safety, if you like, would be a negative result for CAD yen, the Canadian dollar being a risk-off currency to some, and the yen being a risk-on currency to some. Sorry, reverse that. The yen being a risk-off currency, the CAD being a risk-on currency. There's a big twist involved in that because the CAD's also based on, not based, but intertwined with things like oil and things like commodities, which have got their own story in these times of conflict. So, this one's a very, very tricky one to trade, in my humble opinion. Therefore, I'd want to be steering clear of that. But get away from the risk-on, risk-off scenario and go with a currency pair like euro-pound. And this is very, very clear that this wants to go long in terms of the weekly game changer bar. Game changer bar being one whose one whose low is lower than the previous and closes on near its high. So I'd be expecting that to go along, and it may well do that for a period of time. But then I've got a resistance level to consider and all of those things. But then I consider what's happening in Europe. The pound had a shocking week last week, and the euro didn't have such a bad one at the end of the day, as you can see by that chart. But when I think about that, maybe I shouldn't think about that. Maybe I should just trade the charts. And I think Julian was talking about that earlier. Trade what you would normally trade. But here's my take on that. My take on that is trade it at smaller risk than you would normally do. That would most definitely be my counsel on that. And listen to the news, listen to what's going on. So rather than me going through all of these charts that are 9 in number and saying, I'm not going to trade that because, I'm not going to trade that because, I'm not going to trade that because, I'm going to, if I'm in front of the news and can see what's happening, I will make my decisions based on that. If I'm not, then I will stay out of the market. So there's not a lot of point in me saying to you, okay, here's what I'm thinking for the week ahead, because I'm actually not thinking that for the week ahead. I'm going to wait and see exactly what pans out. Sorry, David, that you've missed the answer. I'm pretty sure we'll catch you tomorrow in Trading Buddies. So if that's the case, then I'll give you that answer at that point. No problem. So with that, guys, I think it was pretty much not about what I think today. It was pretty much about what Julian has delivered to us. And we're very, very grateful to have him in our family at ATW. That's for sure, because he's got the experience. He knows what these things bring to us and how we should approach them. I would advise you to do a very, very long think about what he said today and approach that in the coming week, maybe months ahead. So we'll sign off there and say thank you so much, and we'll catch up with you next Sunday when we'll do it all again. Have a wonderful week ahead. Stay safe. Bye-bye.